of the year. What do you make of this? Is just the markets taking a breather, or this is a signal of a meaningful pullback?
I think it's been a very interesting year. It's been a very eventful year. Brexit right in the middle of the year caused a lot of volatility. We then had the US election. We had the markets on edge all year, waiting for the Federal Reserve, and they didn't move until December. So I think many traders are now standing back, looking forward, looking to 2017, waiting for that inauguration to go through, seeing where base metal prices, commodity prices, energy prices go, and then having a look at where the bond market goes, obviously to dictate where equity prices go. So much has happened this year. And it's no surprise to see traders standing back and taking a little bit of a breather.
Yeah, you mentioned about this run we've seen in commodities as well. I thought it was interesting, as you did mention in your notes, that commodities are still looking pretty good right now. But I wanted to get your take on what this means for stocks. So throw up the chart for Peter and our viewers to see, because once we do see this kind of relationship when they diverge, and we see quite a bit of divergence of late, does this point to more pain ahead for stocks in 2017, Peter?
Well, it depends which stocks and which indices. Because where I'm sitting here in Australia, we are waiting. We can't wait for commodity prices to pop out because we have an index that is still quite exposed to commodities. So it depends really on which market, on which equities. They do converge. I think energy tends to converge the most with growth equities or financial equities, because when energy prices are rising, bond yields are also rising, and the financials are somewhat neglected in a rising interest rate environment. So we'd love for energy and commodity prices to continue rising, particularly in this country, and particularly the government in Australia, which is very much leveraged to higher bulk commodity prices to help plug some pain in the budget.
And you mentioned about the runs that you have seen on the ASX 200. My colleague David Inglis is saying how you've really reached those 17-month highs. Given how stretched some of these markets are, in particular Japan, where we're seeing overbought signals for much of the market, is it now time to start de-risking? And really, how are you hedging before Inauguration Day, January 20th?
That's a great point, because I think the Asian markets have really lagged the current rally in the US. The US equity markets are near historically high levels. It's been a beautiful run since 2012. But the Asian markets have been reeling. The Asian markets have been lagging. Japan is an exception because of the huge impact that monetary policy is having there. But if you have a look at this market in Australia, for example, the ASX 200 index is still well below where it was the pre-crisis level in 2007 and 2008. So we're playing catch up, and I think 2017 and 2018 will continue to be years where emerging markets, and in particular Asian equities, Asian exposed equities, play catch up, and you might have some more consolidation in the United States. Europe is a bit of a funny one because there's still balance sheet risk for a lot of European equities. I'm not sure if that's been completely priced through. Maybe we'll start to see some more recapitalization of those balance sheets in 2017, and then maybe they can also start playing catch up in the second half of 2017.
Okay, and you mentioned about emerging markets, Peter, and I thought it was just very interesting given just how strong the dollar has been, I mean, which would impact emerging markets quite a bit. There's a strong dollar and there's a much stronger dollar, which could be an issue. So when does that all start to hurt?
It starts to hurt when the currency goes against you, the bond market goes against you, the cost of debt rises, and as a business, as an equity or as a market of equities, you can't then grow your earnings to offset that. So I think the businesses that are really weak are going to struggle. The businesses that have been bid up, I think a lot of the technology space that has been bid up purely based on hope and purely in a low interest rate environment, if there isn't substance there, then I think 2017 will be a period of realization. The gap between the so-called growth stocks that don't earn money and the equities that have been neglected, like resource equities, for example, that have been completely discarded, I think that gap will start to close. And I think the currency will play an impact, but at the end of the day, for equities, if the earnings aren't there, all bets are off.
Right, you've got to follow up some of that fluff with substance, right? So, Peter, I want to get back, though, to the oil markets.
Absolutely.
Because you mentioned before about the performance and the bullish performance we've seen in oil prices this year. And I want to just pull up a chart here on our Bloomberg terminal, which shows you the relative performance of WTI crude compared to the Bloomberg Commodities Index. And you see that finally, after 2 years of underperformance, it's actually going to outperform other commodities this year if we're set on track to what we've seen so far. So how does that change the game next year for oil and exposure to energy?
Well, a lot of those large energy exporters have actually been repricing since September. If you have a look at Woodside Petroleum, if you have a look at Origin Energy, Santos, if you have a look at a lot of the Malaysian exposures that are listed on the market, and even if you have a look at the US major oil producers and energy producers, there's been a repricing, but the repricing has been for the large caps. The mid to small caps haven't experienced that. They haven't benefited from that because where the oil price and where energy prices are at the moment, they basically provide enough of a buffer for the large names to do well, but not enough for the small emerging names to ride off the back of that. And I think this is really playing producers because they can take away market share, they can dominate, they can drive out competition in the industry, and they can help insulate their earnings. What I'll look for in 2017 is the way they invest. Are they committing capital? Are they committing their balance sheet to expansion, or are they still bunkering down and waiting for more stability?